Dear investors, as we approach the new year, we believe markets are interestingly poised and offer upsides for the following reasons. One, we believe it's growth that delivers performance for equities, and going forward, clearly the sense is that growth outlook has improved, growth has bottomed out. What is clearly happening is that the base effect will come into play. Last year, around this time, growth started to move down, and unless things worsen from here on a point to point basis, growth will start to look significantly better. Our sense, looking at numbers, is that growth has not gotten worsened. The markets have maintained the momentum which was there over the past several months. The other reason for growth to improve would be a narrowing of our trade deficit. It was running very high on account of higher oil imports. Maybe over a period of time, as oil imports reduce in intensity, the trade deficit numbers would start to look better. So that was point number one. Point number two is that the breadth of the market is definitely seen to be improving. Over the past month or so, several events have happened in the Indian market which has made a lot of positive news for a large part of the market. So, for example, there has been acquisition in the liquor space which has changed the business dynamics for this space. There has been an reform process in the power sector for the power sector financials, and that improves the outlook there. In case of cement, the capacity utilization may have troughed, and going forward one may start to see better capacity utilization. For a large part of the levered market, there is a expectation of interest rate cuts in the month of January, and hence the small point is that a very large part of the market is looking at something good over the next month or so, and that should keep valuations steady or improving over the next foreseeable period. Third, reforms which seem to have stalled have again recommenced. We have seen a flurry of moves in the past. Recently enough, FDI in retail has been approved, and while something was not expected in terms of direct cash transfers to the needy, that is the process that has also been started. And we believe this is something which can have very positive implications for the economy and for several companies as we move forward. This is because over time we believe this will result in market pricing of goods such as refined oil refined products, and hence the companies in this space may end up trading at full potential rather than at depressed valuations of the present. Lastly, we should see the market as to what has been happening in terms of the concerns and how are they being addressed. So yes, even as of now, concerns are many. However, we have a sense that as we approach the concern area, the concerns are getting pushed further down into the future or are getting addressed. So, for example, Indian rating were reaffirmed by Moody's, and that took away a big concern for the market. Similarly, there were credible packages for countries like Greece and Spain much before the due date, and that again took away a large concern for the market. The growth concern that the markets have over the last few data points, we have seen growth from areas like China, from areas like India, to be significantly better than expectations. And clearly the sense is that going forward we get at least as much growth that we have seen in 2012 or maybe slightly better and not worse. So clearly there is a sense that worse is behind us, economy is in good hands, policy making is continuing. Even let's say the fiscal cliff concern on the US, wherein a few days back there were increased concerns as to whether the two sides would be talking to each other and whether we would get to a resolution. Increasingly, it seems like that we will have a deal sometimes in the month of January. Clearly, it seems like concerns are getting taken care of or getting pushed into the future. That's not to say that concerns don't remain. They are definitely there, especially in areas like large fiscal deficit for Indian government finances, large trade deficit that the country is experiencing, and so on. But that said, on the margin, clearly the concerns that there were are lower than what it used to be a few months back. Lastly, while this has been the order, we are looking at lowered concerns. We are looking at economic growth accelerating going forward. We are looking at interest rate cuts starting to happen in India. The valuations are still offering significant upsides on a valuation parameter like price to earnings. And mind you, in bad times like these, earnings tend to get depressed because of lower margins and other input pressures, including wages. Yet, on a P like parameter, we are still trading at average valuations rather than at expensive valuations. On a valuation parameter like price to book, we are trading at one of the cheapest valuations that we have seen over the past 10 odd years. While things would seem to be getting better going forward, the valuations still offer a lot of comfort. And that is our reason to believe that chances of the markets doing better going forward would be much more than the markets not doing so going forward. There are parts of the economy which may start to do better. There are some concern areas, and we have formulated our portfolio strategy to be with the parts of the economy which have been doing well and which are expected to continue to do well going forward as well. So, consumption theme is something that has been doing well for India. We continue to believe that that's a part of the market that will continue to behave, especially because in a year and a half, there would be general elections. And as a run up to the general elections, the consumption is always seen to increase as transfers from center to the states, transfers from center to the needy are increased. Secondly, we are also focused on export oriented businesses. We believe that the depreciation of the rupee that has already occurred would aid margins in businesses which have pricing power. So, we are really focused on two areas. One is two-wheeler exports. There the companies have demonstrated reasonably good pricing power. And second, the pharmaceutical export businesses. Here again, the price of the pharma compound is derived from what the market may sustain rather than the rupee dollar rate. So, businesses which can retain the benefit of depreciating currency are businesses that we are positive on. At this point in time, our portfolios reflect two-wheelers and pharmaceuticals. We are reasonably underweight on capital goods, but we have some weightage from a nil weightage some time back, just to reflect the changing mode, the positiveness that is creeping into the market in terms of better growth going forward. Lastly, as a way to play the cheap valuations, the improved economic outlook, we believe our exposure to the financial sector would stand us in good stead. This is a space that we are currently overweight on in many of our concepts. We believe banks would benefit on account of lower interest rates going forward through gains on the treasury book. They would benefit on account of lower NPAs, because if interest rates go down, businesses would be in better position to pay off or meet their financial commitments to the banks. This is basically our positioning at this point in time. The rest of the portfolio would have lots of bottoms up ideas wherein the businesses are high quality, growth would be significantly above markets and where we believe valuation comfort lies. So this is the makeup of the portfolio on parameters like growth, on parameters like quality of business as measured by ROCE and dividend payout ratios. We believe all of our concepts would present significantly better numbers than the broad market, and hence we are reasonably confident of doing better than the broad market. Thank you.